Dinar shift. The world of international currency is currently experiencing a tremor of anticipation, a feeling of structural movement that hasn't been sensed in years. We're talking tonight about the persistent yet often elusive story of the Iraqi Dinar and its potential revaluation or RV, a development that, if confirmed, would represent a significant milestone in global financial history. What's driving this current wave of intense focus are circulating reports suggesting the U.S. Treasury may have quietly set the operational wheels in motion for final exchange procedures, with a symbolic starting date possibly converging around the middle of this November. This is more than just a currency adjustment, it speaks to a potentially major recalibration of the global financial hierarchy, one where emerging market currencies might finally find a stable, modern footing alongside the traditional powerhouses like the US dollar and the Oz euro. The attention is primarily focused on what is being described by various sources as internal banking communications, signaling a state of readiness. Reports that began late last week within certain financial circles indicated that high-level memos had been distributed among key divisions of major, Tier 1 banking institutions, including recognizable names such as JP Morgan Chase, Wells Fargo, and HSBCs. These memos, while highly discreet and guarded in their phrasing, reportedly referred to a transition into a live operational readiness phase. This critical phase, in the tightly controlled world of high finance, means the foundational technology, the secured accounts, and the complex liquidity mechanisms have reached a synchronized state, awaiting only the final activation signal from the relevant central authorities. 2. The terminology itself suggests a methodical and prepared approach, far removed from sudden, chaotic market events. The internal directives reportedly point to the activation of controlled exchange activities, designed to begin in a structured manner this month. The key mechanism at work appears to be the Treasury's Global Currency Asset Division, which, in this narrative, holds the responsibility for managing the technical and regulatory architecture of such a significant currency conversion. This division has supposedly been working in lockstep with the Central Bank of Iraq (CBI) to ensure their most recent system upgrades are fully aligned with the global banking network's protocols. This unified approach is crucial to maintain a single, consistent rate protocol across all participating institutions once any activity begins. While there has been no official, public confirmation from the U.S. Treasury, financial analysts often point to this particular pattern of quiet internal rollouts preceding any official public acknowledgement. This is a common strategy in controlled financial transitions, where large institutions need to be fully prepared and synchronized before any potential news is released to the broader public, thus mitigating market shock and ensuring stability. If the reports prove accurate, they would mark the first concrete, verifiable operational phase of a currency recalibration that has been the subject of global anticipation for years. Such a development would undoubtedly have substantial implications for the international monetary landscape, signaling a shift in how nations manage trade and economic sovereignty. 2. The context for this potential revaluation extends far beyond Iraq itself, touching upon a wider transformation in the global monetary order. The present decade has shown increasingly powerful signs of a move away from the exclusive dominance of the US dollar as the primary medium of global exchange. Across the Middle East and Asia, nations are actively recalibrating their economic strategies, choosing to anchor their national currencies to tangible assets. These assets include the classic mainstays like gold and gas, oil, alongside emerging resources like rare earth minerals, and incorporating modern mechanisms such as digital trade settlements conducted in their own respective national currencies. Amidst this global repositioning, FACR emerges as a nation now intent on asserting its financial independence. After years dedicated to reconstruction and essential financial stabilization, Iraq is well positioned to leverage its immense resources, namely its expanding oil output and significantly rising gold reserves. Its reconstruction-fueled economy is gaining considerable momentum, allowing the country to transition from theoretical discussions about currency revaluation to the practical implementation of necessary financial reforms. This move is less about a single event and more about Iraq establishing the dinar as a robust pillar within a new, evolving world financial structure. 2 concrete indicators support Iraq's increased financial capacity and confidence. Recent reports from authoritative sources like Forbes Middle East and Bloomberg Arabia have highlighted that Iraq's foreign reserves have surpassed a significant $100 billion mark. This record level is a powerful demonstration of the nation's capacity for its monetary flexibility and serves as an important psychological marker of confidence in the nation's fiscal health. Coupled with a consistently strong base of oil exports and strategic partnerships with major regional development funds, these factors collectively paint a picture of a country that is systematically preparing to assert its independent economic strength on the global stage. 2. For global financial markets, the potential revaluation of the Iraqi dinar symbolizes a far-reaching realignment of established trade flows. Iraq, along with its regional allies, is increasingly seeking deeper integration into a multipolar, asset-backed trading framework. This framework, which ties currency value more directly to verified physical and digital assets, has the potential to gradually redefine the very nature of value and exchange in the 21st century. This shift suggests a move away from purely fiat currencies toward a system that emphasizes a tangible backing, adding a layer of perceived security and stability to the monetary system. the nuanced signals reportedly emanating from the U.S. Treasury and the global banking networks are prompting a more sophisticated level of interpretation from seasoned economic experts. Elias Karim, a former consultant with the International Monetary Fund (IMF) and advisor to various Gulf institutions, suggests that the CBI's ongoing as-internal balance sheet revisions, when paired with the synchronized actions reportedly being taken by the Treasury, strongly imply that the operational testing of new rate structures is likely underway. While any such process is inherently multi-phased and requires cautious handling, his assessment indicates that the necessary technical and regulatory groundwork has matured sufficiently to allow for pilot operations within select, controlled Tier 1 banking channels. This view is echoed by other leading financial thinkers, such as Anna Devaru, a prominent global banking strategist. Her analysis emphasizes that any forthcoming event involving the Iraqi currency should not be viewed narrowly as a simple revaluation, but rather as one component of a much broader global transition toward a MS-integrated, asset-backed digital trading environment. Modern financial architecture increasingly relies on sophisticated mechanisms such as AVS blockchain verification, asset tokenization, and instantaneous settlement systems. These technological factors are now profoundly shaping the monetary strategies of sovereign nations worldwide, moving them toward greater transparency and speed. These combined insights highlight a crucial distinction between market speculation and meticulously structured institutional execution. The information that may have once circulated as mere rumor is now, in this theoretical framework, acquiring the weight and seriousness of internal institutional logistics. The prevailing sense among professional observers suggests that this current phase represents the early logistical planning of a system-wide upgrade. This upgrade is ostensibly designed to align key emerging market currencies, including the Iraqi dinar, with a more transparent, technology-driven global economy, whereas fiscal credibility and data integrity are established as the new cornerstones of global financial power and security. In the timeline of this theoretical scenario, the middle of November, symbolized here by November 13th, is being cast as the notional start date of what Treasury insiders have labeled the vast structured liquidity rollout phase. Under this imagined framework, the major banking institutions would transition from months of internal system testing into a live, yet controlled, exchange environment. This environment is designed specifically to carefully assess the secure flow of new liquidity through highly regulated channels. The purpose of this control is to test the system's ability to handle the volume and verify the authenticity of the transactions without causing market destabilization. Within this planned framework, pre-approved redemption centers, operating under secure Tier 1 bank oversight, would reportedly initiate as appointment-based sessions for clients who meet specific, pre-qualified criteria. This approach is intended to ensure the entire process remains deliberate, transparent, and manageable. Each designated regional hub, spanning major cities from New York to Houston to Los Angeles, would maintain a fixed number of operational slots. This measure is designed to proactively prevent any sudden market saturation and to safeguard the stability of the established exchange rate as the process unfolds across various locations simultaneously. For investors participating in this hypothetical rollout, the process would demand calmness and methodical organization. The key steps would involve rigorous documentation verification, the secure scanning of government-issued identification, and the authentication of higher denomination currency notes using advanced anti-counterfeit technology. This multi-layered security procedure aims to protect both the institutions and the integrity of the currency itself. Simultaneously, the notional Central Bank of Iraq (CBI) would, in this narrative, be finalizing its own Phase 2 domestically, which includes the physical rollout of lower denomination notes and the activation of new digital verification protocols designed to normalize pricing under a newly recalibrated rate system. The overall effect, as dramatized in this vision, is one of high security precision. The entire event is staged not as a sudden, overwhelming windfall but as a disciplined, phased liquidity exercise. It is designed to rigorously test both the technological readiness of the global financial system and the necessary patience and adherence to protocol expected of the participants. This deliberate pace is a fundamental feature of the hypothetical plan, emphasizing stability and control over speed. The coordination required across multi-international financial entities underscores the complexity of such a large-scale monetary shift. Within the closed financial test environments of this fictional narrative, speculative numbers for the new dinar exchange rate are being carefully discussed and modeled. Analysts who monitor simulated rate screens in these controlled systems have reportedly noted figures fluctuating between 3.82 and 4.96 per Iraqi dinar. While these values are confined to private, unverified simulations and are not public foreign exchange listings, they serve as crucial placeholders within the closed system modeling. Their consistency across simulations run by institutions like Wells Fargo, Chase, and HSBC, in this imagined scenario, suggests a structured, rather than coincidental, approach to potential future valuation. Two parallel internal whispers, according to this narrative, also suggest provisional testing for the Vietnamese dong of VND, with hypothetical rates being modeled between 0.45 and 0.93. This hints within the creative scenario at a broader Asian currency realignment unfolding beneath the surface of public financial awareness. Commentators emphasize that while these simulated figures are highly compelling, they are strictly hypothetical and limited to modeling systems. Nevertheless, a 25,000 EQD note, when calculated at such imagined valuations, could notionally equate to a value exceeding 100,000 USDs, a dramatic outcome that fuels the compelling narrative of a potential wealth transfer year. Yet, even within this dramatic depiction, experienced economists would certainly offer a necessary caution against unchecked enthusiasm. In any realistic financial transition of this magnitude, the processes of rate discovery, liquidity control, and formal international validation must precede any tangible payout to the public. The speculative rates in this story, while exciting, serve more as a symbol of the immense optimism surrounding the global monetary evolution toward asset-backed systems, rather than a literal promise of overnight wealth. The actual process would be guided by economic reality and regulated governance, not mere anticipation. Turning to the Iraqi side of this hypothetical storyline, the internal momentum is presented as building through a series of crucial closed-door meetings. The narrative posits that AS Prime Minister Mohammed Shia al-Sudani and as CBI Governor Ali Ali, along with accompanying Treasury envoys and as IMF observers, have been convening to finalize the complex technical alignment between Baghdad's fiscal policies and those of its external monetary partners. These are the detailed, often unseen, actions that underpin any major national financial change, emphasizing cooperation between sovereign economic authorities. In this imagined world, a key milestone is reached with the fictional publication of AS Policy Addendum in the Iraqi Gazette, marking the completion of the 2025 national budget, which is entirely denominated in AS Dinar rather than in US dollars. This would be interpreted as a potent symbolic shift toward genuine monetary independence. Furthermore, major energy contracts with international firms such as TotalEnergies, BPDES, and AS Halliburton are shown transitioning to dinar-based settlements, featuring parity clauses tied to the new rate model. These developments, whether viewed as a fictional projection or as a metaphor for Iraq's very real economic aspirations, serve to illustrate how a nation can strategically work to reclaim the valuation authority over its own significant natural resources. Observers within the story's frame interpret these signals as robust evidence of AS real operational readiness. This narrative arc ultimately underscores a universal economic truth: sustainable national currency strength is not born from sudden, unpredictable revaluations, but from years of disciplined policy, significant infrastructure investment, and the establishment of transparent economic governance. This fictionalized exchange event is positioned within the context of a larger, structural evolution in the international financial order, what speculative analysts often refer as global currency reset, or asset-backed reform. Under this imaginative construct, nations are hypothetically shifting away from the old fiat money model toward systems more profoundly rooted in measurable resources, as verified digital assets and transparent productivity indicators. Iraq's currency realignment, in this narrative, is therefore portrayed not as an isolated national adjustment but as one critical element of a synchronized, multi-nation experiment in achieving genuine economic sovereignty. The present year 2025 represents a convergence point in this speculative framework. It is depicted as a time when central banks are actively testing AS blockchain-secured asset registers, piloting programs for digital clearing through frameworks like the Barais settlement mechanism, and exploring experimental architectures often attributed to the theoretical quantum financial system QFS. Simultaneously, the global implementation of ICE 2022 digital compliance protocols is enabling smoother integration between traditional financial platforms and emerging monetary technologies. Within this imagined financial landscape, investors who hold the Iraqi Dinar's IQD or the Vietnamese Dong of VND are portrayed as standing at between two financial worlds: the sunset of a reliance on purely fiat currency and the dawn of a new era defined by AS asset-backed valuation. While the concept of a fully coordinated global reset remains a speculative idea, the underlying necessity for monetary modernization is a very real phenomenon, reflecting the ongoing global effort to align financial systems with tangible value, enhanced security, and technological precision. The timing of this theoretical revaluation, within the context of this dramatized economic report, is presented as both deliberate and strategic. Iraq, as envisioned here, has reportedly achieved significant macroeconomic stabilization through a reduction in inflation, better management of its substantial oil revenues, and disciplined accumulation of reserves. The government, according to this narrative, finalizes a massive 70 trillion dinar budget that is structured entirely in domestic currency, a powerful policy signal of its commitment to its internal strength over external dependence or dollarization. On the global stage, the fictional Treasury's internal recalibration aligns with shifting geopolitical currents, escalating U.S. debt pressures, persistent global inflationary cycles, and a renewed emphasis on bilateral trade settlements that are designed to bypass traditional reserve currency bottlenecks. By hypothetically supporting the dinar's appreciation through controlled coordination with major global banks, the Treasury in this imagined universe is portrayed as achieving multiple, mutually beneficial goals: promoting trade stability, preserving resource access, and offering American investors participation in an equitable asset-based rebalancing. Within the internal logic of this story, this convergence of events is not a coincidence but a intentional piece of economic choreography. Behind the scenes, simulated liquidity flows and digital compliance audits form the unseen, technical framework for what is being presented as monetary modernization through international partnership. Whether interpreted as a forecast of future events or purely as a work of financial fiction, the underlying message remains consistent. That strategic timing and fiscal coherence are the indispensable cornerstones of any credible monetary shift, fictional or otherwise. 2. For the global investor community portrayed in this narrative, the emotional charge surrounding these developments is palpable. Online message boards, dedicated financial channels, and long-running discussions pulse with intense activity as followers dissect every subtle whisper of potential confirmation. For years, holders of the Iraqi Dinar and Vietnamese Dong have navigated challenging cycles of speculation, skepticism, and persistent hope. Now, in this imagined world, their extraordinary patience is seemingly on the verge of tangible validation. Many describe the feeling as a powerful combination of exhilaration and humbling relief. This collective relief stems from the realization that years of endurance through market ridicule and uncertainty may soon yield a significant, tangible reward. Across multiple continents, participants are preparing their essential documentation, meticulously double-checking currency note serials and coordinating appointments for the structured exchanges. The atmosphere is depicted as charged, yet notably disciplined, an undercurrent of profound optimism that is thoughtfully tempered by a newfound respect for formal procedure. The moment in this dramatized depiction transcends mere potential profit, it becomes symbolic of belief that has been rewarded. Within this imagined financial narrative, the operational rollout of the exchange process unfolds through a tightly sequenced structure, engineered for maximum precision, security, and verification. The process begins with a formal confirmation notice, either a simulated Treasury communique or a Central Bank of Iraq bulletin, which acts as the trigger to activate the internal systems of all designated Tier 1 banking institutions. This formal, documented step is paramount to establishing the legality and procedural integrity of the entire operation. 2. Following this activation, the investors portrayed in this scenario would receive access-coded notifications through secure, encrypted portals or dedicated hotline scheduling systems directing them to book their individual exchange appointments. Has identity authentication becomes the subsequent critical priority. Passports, national IDs, and the currency note serials themselves are verified under multi-layered anti-fraud protocols utilizing ultraviolet scanning, forensic watermark analysis, and the VAT blockchain registration of each unique transaction ID. Once both the identity of the holder and the authenticity of the currency are irrefutably established, the participating banks would issue a provisional redemption quote, effectively locking the fictional exchange rate into a secure ledger. For holders of larger amounts, optional structured payout programs are offered, designed to balance the provision of liquidity with necessary regulatory oversight. The newly exchanged funds are then deposited into specific, transitional holding accounts, which are monitored closely by compliance officers and digital security custodians for a set period. 2. The entire segment closes with crucial financial advisory guidance on tax implications, recommended reinvestment strategies, and essential personal security best practices. This step reinforces the central theme that even within this dramatized world of high finance, order and rigorous governance are paramount. Every step is depicted as methodical, precise, and engineered specifically to protect both the institutional integrity of the banks and the financial security of the individual participant involved in the process. Amidst the swirling noise of market speculation and intense public expectation within this fictional universe, the narrative voice often offers a moment of reflective counsel. The mantra of stay calm, stay informed, stay ready, becomes the guiding mindset for those awaiting a significant transformation. This message deliberately emphasizes discipline over excitement, reminding participants that every major shift in financial history, from the adoption of the gold standard to the rise of central banking and modern digital assets, ultimately rewarded those who combined unwavering patience with meticulous preparation. In this imagined world, years of gnawing uncertainty are said to have tempered the initial speculative belief into as quiet, firm confidence. The story frames patience itself as a financial virtue, positioning resilience as the unseen, valuable currency of eventual success. Through carefully constructed language, the narrative deliberately contrasts sensational rumor with the need for steady procedural readiness. It powerfully underscores the idea that the strongest, most successful investors are those who are consistently guided by verified data and institutional process, rather than by volatile market emotion. The closing refrain, every major wealth shift begins quietly, then suddenly becomes undeniable, captures the universal human desire for meaning behind an act of long-term endurance. Even though the scenario remains an exercise in financial fiction, the emotional truth resonates. Lasting prosperity rarely arrives in a moment of chaos. It is earned through a clear vision held firmly amid periods of pervasive doubt. This final segment functions less as a direct prediction and more as a compelling parabolas, a call for composure and responsibility during times when the high anticipation could easily overshadow prudent, necessary action. In a final chapter of this speculative broadcast, attention is shifted to the digital domain, where the data streams and algorithmic whispers hint at the very real possibility of impending change. Within the narrative, backend is Forex terminals, specifically mentioning platforms like Reuters dealing $3,000 and Bloomberg FX along with proprietary interbank systems, begin to display intermittent, locked indicators beside the IQD currency pair. To the untrained casual eye, these flashes appear trivial and insignificant, However, to the seasoned traders and technicians in the story, these subtle digital signals indicate deep, internal back-end synchronization and critical SAR system maintenance if the necessary, quiet precursor to any major monetary update. Technicians in fictional trading rooms monitor complex latency metrics, noting that the rate servers are methodically cycling through eyes and recalibration protocols. The segment dramatizes the atmosphere, muted screens glowing, analysts exchanging quick, knowing glances, and compliance officers verifying that all digital pipelines remain fully secure and operational. The narrator explains that a locked rate itself does not serve as a guarantee of a value movement, but rather as definitive proof that the essential integration scripts are running, which is a non-negotiable phase in every controlled monetary update. Historical parallels are drawn to prior system overhauls, such as the meticulous euro conversion testing conducted in the late 1990s or the complex Gov blockchain ledger pilots involved in early 21st century financial reforms. By closing on this note, the broadcast successfully maintains a high degree of suspense while simultaneously grounding the event in plausible, established technological procedure. In this creative framing, quiet digital synchronization becomes the modern symbol of profound monetary transformation, silent lines of code preparing to reshape a financial world that, for now, exists only in the imagination of those who follow this story. The final message is one of technological inevitability, asserting that the unseen digital infrastructure is the foundational framework for the economic shifts of tomorrow. The broadcast concludes with a call for listeners to remain engaged, informed, and prepared for the next phase of this deeply complex, globally significant financial development.